Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right, my name is Mark Eitel. You are tuned into the Mr. Mortgage Show, and sit tight, guys. We have an awesome show lined up for you this week. I am so glad you're with us. We are going to talk about all of those headlines regarding the Robinhood administration charging the good credit score borrowers so they can give a break to the bad credit score borrower. Guys, we're going to dive into all of that, right? There's so much information there. And I agree, everybody should be frustrated, but the headlines are deceiving, guys. It's not as simple as what you're seeing in the headlines. There's way, way more to it, and a lot of people misunderstand what's going on in the headlines. So we are going to deep dive all of that, the LLPAs, as they're called, loan level pricing adjustments. I might even sing LLPA to the tune of YMCA. I'm threatening, guys. I might even break into song. But listen, I'm equally worked up about this. It's frustrating. I don't agree with it, but I do think it's helpful to have all of the information because, as I mentioned, it's being misrepresented by catchphrases and headlines. So we're going to dive into all of that. But one more time, my name is Mark Eitel. This is the Mr. Mortgage Show, guys. It is always our goal to give you the data, the information, the tips, the tricks, the strategies, and of course, the answers to all your questions so you can go out there and make better real estate and mortgage decisions for you and your family. And I know for the last week or so, I've been getting a load of questions about these pricing adjustments in the headlines. So I know there are people out there that are wondering what in the heck's going on. So we're going to dive into that first. But guys, if you've got questions or comments along the way, call or text 855-462-7292. That's the Anytime Hotline, 855-462-7292. Jen, my producer, is standing by, womanning the hotline, and she'll get your questions on the air. Again, that number is 855-462-7292, or shoot us an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, type your question, hit send, and she'll read it on the air for you. But guys, let's dive right in. I know anybody with an internet connection, a smartphone, or somebody who's flipped on the evening news in the last week or so is wondering what is going on. Have we lost our minds? Are we really charging higher credit score borrowers a higher interest rate so we can charge lower credit score borrowers a better interest rate? What's going on? How is any of this fair? Well, firstly, guys, it's not fair. It's absolutely not fair. I disagree with it wholeheartedly. I don't think any of these fees should be increased for any of the borrower categories. So now that we've gotten that out of the way, and I'm not going to make this political, I want to talk about the fundamentals of what's happening. So where I'm seeing everybody get this wrong is, first of all, these aren't new fees. These fees have been in place for well over a decade. These are adjustments to existing fees. So that's the first thing I think a lot of people misunderstand. These are adjustments to existing fees, not an arbitrary new fee structure that's just been put in place. So we've gotten that one covered. Number two is these aren't lump sum fees being added to your closing costs. And that's why most people never even knew they existed. These fees are built into your interest rate. So yes, interest rates are going to go up because the fees associated with certain categories are going up. And that happens to be the higher credit score borrower. Now, the lower credit score borrower is going to see a fee reduction. So that's absolutely true, which will result in better interest rates for them. So not a lump sum fee being added to your closing costs. They're built into the rate. That's the second misconception. And that's why most people never knew they existed to begin with. Now, the third thing is this only affects newly originated mortgages that close and are delivered after May 1st. So anything that's now being originated is under these guidelines. And guys, I guess I need to throw that out there too. If you've gotten a rate quote in the last, say month, this is built in. You're already seeing the adjusted rate. These changes were announced in January. And we as an industry pushed back and have been pushing back since January. But it wasn't until somebody did a brilliant job of color coding that matrix and turned it into a heat map, and it made its rounds on the internet, that suddenly everybody understood what was happening. But we as an industry have been pushing back behind the scenes since the beginning of the year because we've known these changes were coming. So that's another thing, guys, that I want everybody to realize is not new fees, not lump sum fees, and only for mortgages being originated. So if you have your mortgage, nobody's changing your interest rate. I've gotten a few phone calls about that, and it's not the case. It's only for new purchase and refinance mortgages under the conventional mortgage underwriting guidelines. And then lastly, it does not benefit you in any way to have a lower credit score, other than you're paying less than you did earlier. And what I mean by that, I've seen news reporters actually suggest it may make sense to miss a car payment, tank your credit score, because you're going to get a better mortgage rate than somebody with a high credit score, impeccable credit history, and a big down payment. Guys, that's not the case. It still costs a higher interest rate because of the fees associated with a lower credit score and a lower down payment than it does with a higher credit score and a higher down payment. So that's the big thing a lot of people are getting wrong. People think suddenly a lower credit score is going to get a better interest rate than a higher credit score. And that's not the case, guys. They're getting a better interest rate compared to what they did 2 months ago, but they're not getting a better interest rate compared to someone that has a higher credit score. And that's what's got everybody angry. It feels like another government subsidy. And I guess let me say this, guys. I don't judge anybody by their credit score. I never have. I never will. Bad credit scores happen to good people for all kinds of reasons. Unforeseen medical expenses, an accident. Who knows? Something happens to your business and you miss a few payments. Guys, in my personal life, I've had amazing credit and I've had crappy credit, and I built myself back up to have good credit again. And I know the value of working hard to have a good credit score and maintaining that credit score. And this doesn't change any of that, guys. None of this changes the fact that having a better credit score and being able to put a larger down payment down is going to get you a better rate than having a lower credit score. So let's get that out of the way because it's super confusing and it's super frustrating. Now to the why this is happening, the popular argument is that we are reducing the costs of the lower credit score borrower to increase access to capital so more people can participate in home ownership. Me personally, I don't completely buy into that, only because the FHA loan programs still beat even these adjusted interest rates and fees for that lower credit score borrower. So in most cases, we already have a better route to capital. We already have a better route to home ownership for the lower credit score, lower down payment borrower. What it feels like is a governmental money grab, and it feels like they're grabbing it from the most capable people of paying it, and that's the high credit score, high down payment borrower. But guys, we're going to dive into all of this. We're going to take your questions. We're going to talk about the effects this may have, both intended and unintended, on the market. But sit tight, guys. It's going to be a great one. But you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, we are wound for sound this week because of all of the LLPA conversations that are good. We're already getting questions, guys. I'm super excited to dive into this with you. And again, I don't agree with it, but it's here, and I just want to explain it to you because in spite of all of this, I think it still makes sense for people to buy houses, and the data is supporting that. So I'm super excited to take your questions. I'm super excited to deep dive this topic. And if you're just joining us, guys, the LLPAs are the loan level pricing adjustments that every dancing mortgage professional on TikTok and Facebook and Instagram, as well as the evening news, has been talking about this last week. We've all seen that color-coded heat map bouncing around the internet. If you haven't, check us out on social media. Go to mrmortgageradio.com and click on the links. We did a video about it that I think helps everybody understand it. But guys, if you've got questions or comments, shoot them over to us. Text or call 855-462-7292. That's 855-462-7292. Jen will get you on the air, or shoot us an email, and do that by visiting mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. But guys, I'm going to dive right into your questions because I see that Jen's got a bunch of them all ready to go. So let me throw it over. Hey, Jen, what do you have?
Gina has a question. So the government has doubled interest rates in the past year. The banks are collapsing. And now this president is punishing people with good credit by raising the rates even more. Do you think this will finally kill the housing market?
Hey, Gina, that is an awesome question, a brilliant observation. I don't think it's going to kill the housing market for a lot of the reasons that I mentioned in the opening segment. These fees are built into the interest rate, and almost everybody who's getting quotes for interest rates in the last 2 or 3 weeks, maybe longer, are getting these new pricing adjustments quoted in their rates. And guys, there was data released this week on CNBC that showed new home sales beat expectations considerably. And people still want to buy houses. Mortgage purchase applications were up. Another data point that was released this week, 5%. And that's in the face of all of these adjustments and in the face of a higher interest rate environment. So while super, super frustrating, and again, there's two things that I can't stress strongly enough. I don't judge anybody by their credit score. I do think there's better access to capital for the lower credit score borrowers than even this improved matrix with the FHA loan product. But that's the first thing. And secondly, I don't think it makes any sense to put a tax, if you will, on the higher credit score borrower to offset risk in any other category. It's definitely feels a bit Robin Hoodish. But all of that being said, the market is what dictates what's happening. And right now, there still appears to be a healthy, robust desire to buy real estate. And I don't think this is going to kill the market. I think what this has done is brought awareness to how unfair, how frustrating this is, and it's given us collectively an opportunity to push back, which I think is awesome because we've been pushing back against this as an industry. And I'll tell you one thing that frustrates me as a mortgage person who's been in this for a long time. Post the housing crash, and I didn't want to make this political, but I don't think it has anything to do with party. But we've had Republican and Democratic presidents since the housing crash. And one thing I want to point out is post the housing crash, there was legislation that was put in place to govern how mortgage companies, originators, loan officers, whatever you want to call them, mortgage brokers, charge clients, right? In the old cowboy days, people were able to charge a lower credit score borrower a higher fee structure than a high credit score borrower. And that was deemed discriminatory, and rightfully so, right? Absolutely rightfully so. But because of that, there was legislation put in place that said we can't give somebody preferential or different or more difficult terms or costs than someone else, right? Equal access to capital. Well, how is this any different? How's it suddenly fair to say, okay, high credit score guy, we're going to charge you a little bit more. Hey, low credit score guy, we're going to charge you a little bit less. So fundamentally, I struggle with this. I think the market should dictate the cost of capital based solely on risk. And if you have a low credit score for whatever reason, again, I don't judge anybody by their credit score, but credit score is a risk factor. It's a criteria that's reviewed when underwriting a mortgage application. And I think it's fair to look at someone's credit history when determining the likelihood that they're going to pay you back if you're loaning them money. So I get it. It's frustrating for a lower credit score borrower to have to pay a higher interest rate, right? Because in theory, they're already having a difficult time managing their finances. So now we're charging them a higher rate, but there's more risk associated with it. And that's where the mortgage insurance piece comes in. And that's another thing that really, really frustrates me about these adjustments. And then I'm going to get off of this and dive back into some questions, is that 80% loan to value. So if you have 20% equity or 20% down payment, that's the threshold that's been established by lenders where they're comfortable with the risk. Because with that 20% equity, they feel very comfortable that should they have to foreclose, they're going to get paid back. There's enough equity in there to absorb all the costs, all the deferred interest payments, everything, and make the lender whole. Well, guys, if you put down less than 20%, you have to get mortgage insurance to insure the lender against that risk over 80%. Well, guys, in that matrix, why are we charging a borrower putting 20% or more down anything? Why are we charging them any adjustments? Because they've already met the requirements established by the lending institution of that 80% loan to value. So clearly, this frustrates me too, but for many different reasons. So guys, I'm going to keep diving into this if you want to keep talking about it, because I think it is definitely the topic of the day and we need to address it. So if you have more questions, just shoot them our way. We'll dive into it. But guys, you hear the music, you know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, my name is Mark Eitel, and this is the Mr. Mortgage Show. And guys, you are loading the board up with questions. I love it. I love it. I love it. There's a lot of questions regarding the loan level pricing adjustments, and we've spent quite a bit of time so far covering that. We'll continue to deep dive it, but I'm going to skip around and take some of the other questions, and then we might come back to that. So, hey guys, if you have questions or comments, give us a call, shoot us a text, 855-462-7292. That's 855-462-7292. You guys have Jen back there jumping today, taking those questions on the hotline. She'll get you on the air. If you prefer to shoot us an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon and you can send your questions in that way. But guys, thank you so much. This has been an amazing start to the show already. Lots of activity, lots of curiosity and confusion and frustration regarding the headlines pertaining to the loan level pricing adjustments and higher interest rates on this guy so that guy gets lower rates. We're going to continue to cover that. But hey, I'm going to throw it over to Jen and we're going to take a few other questions right now. Hey, Jen, what do you have?
Dennis sent us this. We just got hit with the big assessment on our condo. We're about to list the place for sale, and this is going to eat up our equity. Is there any way we can sell and roll the assessment into the sale price?
Hey, Dennis, that, my man, is a brilliant, brilliant idea and a great question. So technically you can if it'll appraise, but here's the challenge. A lot of people are going through this right now. And post the Surfside condo collapse, there's a lot more scrutiny in the review of a condo's budget and management when a lender is considering loaning on a unit in a particular complex. So that's one challenge people with condos, both buying and selling right now, are seeing. And then secondly, the assessments. A lot of the condo boards are just made up of residents who don't want big association fees, so they've been running super lean. And as the buildings get older and need roofs, or the pools need refinished, or there needs to be significant improvements or maintenance made to the grounds, then you're suffering these big assessments. So if the price that you have in mind to sell the property can absorb that, then yeah, I mean, you could pay it off at closing and just have it built into your sales price. But based on your question and your reference to it eating up your equity, you can't sell a $300,000 condo for $300 and then roll a $20,000 assessment into it. So essentially you're selling it for $320. You can't do that unless it appraises for $320. So yeah, I get where you're going with it, but it's unlikely. You'll either have to pay the assessment or you'll have to negotiate with the buyer that they pay the assessment. So I hate that you're in that circumstance, but you're not alone. We're talking to more and more people that are getting hit with big assessments, and I'm more than happy to spend some time with you on the phone if you've got more questions around it and help come up with a possible solution. Just give me a call or shoot me a text. I'll be happy to help if I can. But great question. I'm not quite sure you're going to be able to accomplish what you want to with that. But hey, Jen, do you have another question ready? Okay, what do we have?
Melissa is asking, is the FHA 40-year loan available to first-time home buyers?
Hey, Melissa, that's another good one. That got a lot of headlines a month or so ago, not maybe 3 weeks ago. There's not an FHA 40-year loan yet. And I say yet because it's likely that there may be one in the future. What was floating around social media and the dancing TikTokers and all of that again was that FHA loan modification could allow for a 40-year repayment. But that's a loan that's already in trouble, and the people are going through the modification process. So right now, new purchase mortgages for FHA or refinances for FHA, there's not a 40-year option. So great question, but no, that's not available as a first-time home buyer or otherwise. And guys, fun fact, FHA is not just for first-time buyers. You can do back-to-back FHAs. There's a lot of options with that loan program that people are unaware of. And with these pricing adjustments, FHA may become an option for more and more people because it already carries a favorable rate. So anyway, great question. Hey, Jen, can we squeeze in another one?
This is from Marianne. I got a postcard about selling my house fast for cash. The price is a little low, but they said I can stay 3 months to find a new house. Are there any options that let me sell and take the time to move?
Hey, Marianne, if I understand your question correctly, and I'm just guessing because I might have this wrong, you're asking, are there other options than whoever sent you that postcard? And it's not uncommon for a seller to request what's called post-closing occupancy, and you can essentially lease the house back for up to 59 days if the person buying it intends it to be their primary residence. If they're buying it as an investment property, you could negotiate a longer term to stay there. But that's probably the cleanest deal that would get you the market value for your property, because of a lot of those, as you referenced, a lot of those, we buy for cash, we close fast type of offers are at a lower sales price, and rightfully so. Their intent is to flip it and make a profit in most instances. So yes, there's a convenience factor. And in this instance, it sounds like staying after closing is a desirable convenience factor, but you're paying for it by taking less money for the sales price of the house. So to answer your question, you might want to explore post-closing occupancy, and I'd be happy to walk you through it. If you're not working with an agent already, I'm happy to refer you to somebody in the Really Great Agents Network. You hear me talk about that all the time. If you want information regarding Really Great Agents, just go to mrmortgageradio.com and click on that link. But we can find you an agent that understands and specializes in doing post-closing occupancy, but that might be a strategy that works for you. Hey, Jen, let's try to squeeze in one more.
Andrea sent an email. Are there any special loan programs for a disabled veteran who only has Social Security and disability income?
Hey, Andrea, that's a great question. And my first reaction to that is, let's go VA, because as a disabled vet, there are many benefits to a disabled vet under the VA loan program that include things like a reduced or eliminated funding fee. You're already able to do 100% financing, and disability and Social Security income are permitted as income sources, and oftentimes can be grossed up if they're tax-free income. So I would start with the VA loan, and I would love a chance to talk to you about that. Also, too, a lot of municipalities and states will provide reduced or eliminated real estate taxes for disabled vets depending on their level of disability. So brilliant question. I believe that you'll find a lot of opportunity existing within the VA loan program as it exists, because there are benefits for the disabled vet under the current VA guidelines, including some of those things that I mentioned. So brilliant question. I'd be happy to talk to you in length about that, because the VA loan is a product that's close to my heart, and the VA community is close to my heart too. So if there's anything I can do to help, I'd love a chance to talk to you. But hey guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. Guys, thank you so much for spending a bit of your day with us. I know there's a lot of questions, a lot of confusion around what's going on with these mortgage headlines, and we're super excited to be with you and answer those for you. Guys, if you've got questions or comments, keep them coming. We've got some already back there, but you guys have been great so far. 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is standing by, womanning the Anytime Hotline. She'll get you on the air. If you prefer to shoot your questions over via email, just check out MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over via email. But man, we've had some great ones so far today. A lot of people are super frustrated, angry, and confused by the headlines regarding these loan level pricing adjustments. We've covered it. We will continue to do so. Guys, if there's anything you can take away from all of this, it's that I encourage you to have a conversation with your mortgage professional. And if you don't have a mortgage professional, ding, 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 give us a call. I just raised my hand when I triple dinged right there. We would love to help you any way we can, answer your questions, and certainly help you with your mortgage needs if that is something you would like us to do, guys. We are a full-service mortgage brokerage, have been for a long time. I've been doing this right here since 1999. Man, I'm getting old. But I haven't had this much interest in what's going on with the mortgage world as I have this week in a long time because of those headlines. So keep the questions coming, and we will do our very, very best to answer them. But speaking of your questions, I'm going to throw it over to Jen so we can get some more on the air. Hey, Jen, what do you have?
Carl is asking, is there a maximum amount I can give my son as a down payment? He's buying a house for $450,000, and I'd like to give him $200,000, so his payments are lower.
Hey, Carl, that's a great question, my man. And man, you are a generous dad. Congratulations on being in the position to do that. And I'm sure it's going to help your son get a huge jump start down the equity building path. So I'm excited for both of you. But to answer your question, no, you can give as much as you want. And 200 on 450 is certainly something we've seen before. So to answer your question, you'll be fine. There is not a limit on how much you can give. All of the loan programs are going to require you to execute a gift letter that basically says this is a gift. It requires no repayment. So that's a protocol when gifting money for down payment or closing costs. And then secondly, in some circumstances, you may be required to show where the money came from. So there might be a little bit of documentation, but you'll be fine. And in some cases, there's no documentation as far as sourced and seasoning at all. And another thing we get asked quite often is, can I as a parent take out an equity line and use that equity line money as a gift for my child's down payment? And the answer to that is often yes as well. So brilliant question, Carl. Congratulations on helping your son. And if you need more information, just reach out to us. I am here and happy to help. Hey, Jen, do you have another question?
Ashley sent us this. Are there prepayment penalties on an equity line of credit?
Hey, Ashley, another brilliant question. So equity lines don't have prepayment penalties, but they have oftentimes they have what's called early termination fees. So you'll want to confirm that, because I know that some of them are a percentage of the equity line amount, and some are as little as $500. So yes, that's a brilliant question. And if your goal is a short-term strategy with that equity line, you're going to want to ask what the early termination fees are and how long are they in effect. Are there early termination fees for the first 3 years? Are they for the first 5 years? Get all of that sorted out. But yes, brilliant question. And a lot of people don't even think to ask it. So I appreciate that one. Great question, Ashley. Hey, Jen, do you have another question ready? Okay, what do you have?
Perry is asking, if we do a cash out refinance on our primary house, can we use the cash as a down payment on a new house and keep this as a rental?
Okay, Perry, that is a fantastic question. So if I'm hearing you correctly, or I'm hearing Jen read your question correctly, you're going to pull some cash out of your current house to use to go buy another primary, and you're going to turn your current house into a rental, which is all doable. Now, here's the challenge. If you refinance your current house as a primary residence and then immediately go out and buy another property, well, that's going to fall into the area of occupancy fraud and may require you to refinance the house again into a rental property, investment property type mortgage. So if you're going to do a cash out refinance and in a year or 18 months go buy the other property, that's a non-issue. And I think some loan programs allow this to happen in as little as 6 months. A primary residence always gets a preferential interest rate over an investment property. So if you're refinancing your primary with the intent to immediately turn it into an investment property, then you're getting a preferred interest rate and a preferred loan to value because it's a primary, and now you're turning it in. That might be a challenge. So I'm open to talking with you off the air about it and giving you some workarounds, but it would really come down to your timeline. That's the best way to answer the question. How soon after the cash out refinance do you want to go out and buy another primary? And that's going to dictate whether this is doable or not. So brilliant question. And I see it happen all the time. It makes a lot of sense to do it. You've got equity and you want to go out and buy another property, and you need that equity to do it. So I get it. It's doable. You just might want to be careful how you structure it. So brilliant question. I appreciate you throwing that one our way, and I hope that helps. Hey, Jen, do you have another question?
Shelley wants to know, can we get financing to build our own home as an owner builders? It will be our primary home. We've owned the lot for 7 years, if that matters. Thanks.
Hey, Shelley, that's a great question. And we see a lot of that in the Port St. Lucie area in particular, because there's still some scattered lots available. We see it out in the acreage in western Palm Beach County. Yes, to answer your question, there are loan programs available for owner-builder construction financing. And you threw an interesting piece of information in your question. You said you owned the lot for 7 years. Now, this is interesting because the way the equity position works from the bank standpoint when you own the property is if you buy a property and you've owned it for less than 12 months when you start the construction process and you're getting a construction perm loan now, they'll take the purchase price. Let's assume you own the lot free and clear. You paid cash for the property. They'll take the purchase price as the equity position for the first 12 months. After 12 months, they'll take the appraised value of the dirt. So in the greater Port St. Lucie area, for example, those lots sold for $5,000 and then $50 and then $100 and then $5 and then $15. So if you are lucky enough to have bought that property for $15,000 and it's now 7 years later worth $115,000, well, guess what? You've got $115,000 in equity in that piece of property. So, and you only paid $15,000 for the lot. So that's where it becomes interesting. Using the appraised value of the lot as the equity position takes effect after 12 months. Prior to 12 months, it's the purchase price. And if you've got a loan on the lot, then the equity position is reduced by whatever the principal amount of the loan is. But to answer your question, it's doable. And the construction perm loan is a very interesting loan product. It requires interest-only payments during the construction period, and those interest-only payments are built into the loan in a reserve account. So it's called interest reserves. They're built into the loan. So assuming that the house is completed on schedule, you won't have to make a mortgage payment during construction because it's self-funding with the interest that's built into the loan, the interest reserve account. Then at CO, it converts to a mortgage and requires payments from that point forward. So brilliant question. If you need more information, you know how to get us, 855-462-7292, or just check out Mr. Mortgage Radio and shoot us over an email. I'll be happy to help. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, thank you for all of your questions and comments. Man, oh man, everybody is wound up, and I absolutely love it. We're still getting questions rolling in here regarding the headlines and the Robinhood is charging more interest to the higher credit score people to give a free ride to the lower credit score people. I get it. It's frustrating. We've covered a lot of it. That's not exactly what's happening, but I get the frustration. And yeah, man, it's been a wild ride this week in the world of mortgage and interest rates. But hey, keep your questions coming. 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is standing by, womaning the hotline. She'll get you on the air or read your questions for you. 855-462-7292. And guys, if you need us when we're not on the air, that number pushes to my office as well. That's why we call it the Anytime hotline. Rings here in the studio when we're doing the show, but also pushes to my office the rest of the week. So feel free to use that anytime. But if you prefer to shoot us an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. But I know we've got some more back there, so I'm going to throw it to Jen for another question. Hey, Jen, okay, go ahead.
Connie has this question. Is it true that good credit people are going to pay higher rates so bad credit people can pay less? How is this fair? There's got to be more to the story.
Hey, Connie, thanks for that. And clearly you missed the opening of the show, but I am super happy to address that one more time. So yes, interest rates are going up for certain higher credit score categories, if you will, and are going down for other lower credit score categories. But a couple things that a lot of people have wrong is, first of all, these aren't new fees. They're adjustments to fees that have been in place for a very long time. They're not lump sum fees, so it's not like a flat, 1% or 0.75% additional is being added to your closing costs. They're built into the interest rate and have been since their inception, and that's why people have never really even known they existed, because the rates that you're getting quoted today already have those adjustments built in. So not lump sums, not new fees. They only affect mortgages being originated now. They don't affect existing mortgages. And then lastly, this is the big one. Guys, there is no benefit to tanking your credit. There's no benefit. It's still far less expensive to borrow money with a higher credit score and a bigger down payment than it is with a lower credit score and a smaller down payment. Yes, the fees are being reduced on one and increased on the other, but there's still a big gap in what those net costs are in relation to each other. So it's absolutely important. It's critical that you maintain your good credit, that you work to get good credit, and then you govern yourselves accordingly so you maintain that good credit. And yes, this is very, very frustrating for a lot of people, me included. It feels wrong. It's definitely got that Robin Hood type of feeling to it, right? Rob the rich and feed the poor type of thing. But there's a lot more to it behind the scenes. We're pushing back as an industry. I encourage everybody to do so as well. But to answer your question, it's not as simple as you're paying more and someone else is paying. Well, it is that simple. I mean, let's face it, it is, but it's not. It's still proportionate to risk. It's still proportionate to credit score, meaning a higher credit score and a higher down payment still pays less fees than a lower credit score and a lower down payment. And I don't know why this is happening. It doesn't make sense to me. The lower credit score and lower down payment borrower has less expensive access to capital through the FHA loan program. And guys, if I can encourage anybody to take anything away from this conversation, it's to make a phone call and have a conversation with your mortgage professional. And guys, we would love that to be us, because a lot of people see that adjustment and they think, oh my God, rates are 6, they're 6.5. And now there's a 3/4 of a point adjustment. That means my rates are going to be 7 or 7.5 or whatever the case may be. That's not the case. They're built into the rate, and it's not a number for number lockstep move. It doesn't cost 3/4 of a point in rate to absorb 3/4 of a point in fee. So I'm happy to talk specific scenarios with anybody. We can look at credit score, we can look at down payment, and I can give you a real actual rate quote of today based on the new adjustments. And most people are surprised to see that it doesn't affect them as negatively as they thought because of that chart that's making it around the internet. Guys, I don't agree with it, but I do happen to understand it. And we've got workarounds for all people on that chart: low credit, high credit, small down payment, big down payment. And I encourage you to have a conversation with your mortgage people or us. I would love it to be us. So great question, but let's keep it rolling. Hey, Jen, what else do you have?
Lewis sent us this. I currently have a house in Tennessee with an FHA mortgage. I'd like to keep this as a rental and move to Florida. Can I get another FHA loan?
Hey, Lewis, that's a brilliant question, my man. And the answer is yes, because you're going from Tennessee to Florida. That's going to meet the FHA departing residence rule, which requires the new house has to be at least 100 miles away from the current house. So under those guidelines, there are circumstances that allow you to buy the second property with an FHA loan. So yes, you can do that. And I'd be happy to discuss the circumstances and the details with you. But yes, that's a doable deal. If it's less than 100 miles, then there's not an opportunity for a second FHA loan, unless there are hardship requirements that are met, and those are difficult in most instances. But given the distance between Tennessee and Florida, you're going to be fine. So brilliant question, my man. Hey, Jen, do you have another question?
Nicole sent this one. If we take a reverse mortgage on our home, can we still leave the house to my daughter? How does that work? Does she take over the loan? Thank you.
Hey, another brilliant question. And we don't talk enough about reverse mortgages on the show. Right now there's a lot of interest in reverse mortgages. We've been providing that for a long time. It's a delicate space, and a reverse mortgage is not for everybody, guys. I get it, and we don't suggest it for everybody. It's a tool. A hammer is a tool that can build a house, but a hammer can also tear a house down. So I'm always cautious with the reverse mortgage space. But to answer your question, you can leave the home to your daughter, and she's going to inherit that property just as she would any other real estate with a mortgage on it. It's just a lien. She's going to be given the opportunity to either sell the property or refinance that mortgage into a new mortgage so that the reverse mortgage is then paid off. But it's just a mortgage lien like any other mortgage. And one other thing that a lot of people are super confused about, let's say property values tank and you owe more when you die than the property's worth. She's not responsible for the deficit. It's a federally insured loan program, and there is no recourse on the heirs if the property is worth less than the lien at the time of your death. So brilliant question. I hope that helps. If you have any questions regarding reverse mortgages, please shoot them to us. We're here and happy to help. Hey, Jen, can we squeeze in one more?
Bradley emailed us this question. How hard is it to refinance a private seller held mortgage? It's been paid on time for more than 2 years, but it doesn't show on my credit report. Is this a problem?
Not necessarily a problem. We're going to look at your bank statements to show that you've made that payment timely. The person you're making those payments to, the private mortgage holder, can also provide a letter that it's paid on time, in good standing, and you should be fine. So not uncommon, not difficult, a little extra paperwork, but I understand your concern and confusion because it's not on your credit report, which is usually how we are able to determine that something is paid on time and is in good standing. So great question. I appreciate that. I hope that helps. And we're seeing more seller-held mortgages moving forward in this market. At least I have in my market. So super interesting. But anyway, guys, you hear the music. You know what that means? We've wrapped up another week of the Mr. Mortgage Show. Man, the time flies when I'm sitting behind the mic. I hope you guys had fun. I know there's still a ton of questions out there regarding loan level pricing. We're here. We're happy to help. We'll answer any of your questions. Give us a call, 855-462-7292. That's 855-462-7292, or check out MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, have an amazing week. We'll see you right back here next week. Same time, same station.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages, right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.